You're listening to the Financial Source podcast on YouTube.
Hi, everyone, and welcome to the Financial Source podcast. We're looking at a fascinating paradox today. The S&P 500 and the Dow are pushing deeper into record territory, yet global trade and geopolitical risks are simultaneously intensifying, creating a real tug-of-war for market direction.
It's a genuine tug-of-war, you're right. I mean, the immediate driver is this lingering optimism from the Federal Reserve's recent dovish rate cut, which continues to pressure the dollar and fuel that risk appetite, keeping investors focused on record highs.
But that positive macro backdrop is running straight into some escalating geopolitical friction and, I guess, physical supply shocks.
It really is.
We're seeing crude oil prices attempting to stabilize as the U.S. prepares to seize additional Venezuelan oil tankers, halting deliveries, and raising some really serious supply concerns.
And on the trade front, the system is fragmenting quickly. You can see it highlighted by Mexico's new tariffs of up to 50% on Chinese goods. And then you have India's ongoing plea for relief from U.S. tariffs because of its Russian oil purchases.
So today, we'll unpack the current session's drivers, focusing on how a heavy slate of Federal Reserve speakers might reshape dollar expectations and how sanctions and tariffs are overriding traditional macro signals across commodities and foreign exchange.
Let's unpack it.
Okay, let's start where the market joy originates, the central bank policy. The market has, it seems, fully internalized a dovish Federal Reserve, and that expectation, the belief in cheaper money for longer, has been the main catalyst, right? Driving equities to these record highs.
Absolutely.
But is this optimism actually grounded in the economic data, or is it just pure policy-driven exuberance that's ignoring the risks we just talked about?
Well, I think it's a pertinent mix of both, but it's definitely leaning toward exuberance. The mechanism is clear. When the market prices in fewer rate hikes, or maybe even future rate cuts, the dollar softens.
Right.
And that takes the pressure off emerging markets and boosts risk assets like equities and gold. We even saw this reflected in the softer jobless claims recently.
Okay, explain that connection for us. Why do jobless claims affect the dollar so directly right now?
It's all about the dual mandate. Soft jobless claims suggest the labor market is still resilient, which, ironically, usually gives the Federal Reserve less cover to cut rates aggressively.
Because if the labor market is strong, inflation risk is still there.
Exactly. So the fact that the dollar is softening suggests traders are focusing not on the resilience, but on the rate of change. They believe the Fed is pivoting regardless of that underlying strength. It's a bet on the policy pivot, not the economy itself.
That makes sense. It sounds like the dollar is basically just treading water, waiting for permission to move again. And that permission is likely coming from this heavy slate of Federal Reserve officials speaking today.
That's the key technical constraint right now. I mean, FX traders are entirely in a wait-and-see mode. We have a string of speakers. I think Paulson, Hammack, Goolsbee, Schmid, and Marin are on the docket.
So a lot of voices.
A lot of voices. And for those tracking the dollar, it's worth noting the differences. For instance, someone like Austin Goolsbee, who's typically seen as a centrist, could subtly challenge the market's really aggressive dovish pricing. Any hint that the inflation fight isn't completely won, that can put a sudden floor back under the dollar.
So if a hawkish voice pushes back, the dollar rallies, and this record equity push could lose some steam. That cautious anticipation was clearly reflected in overnight trading, wasn't it?
Absolutely. The volatility was capped globally. We saw the euro and sterling holding in these incredibly narrow ranges. Cable was pretty much pinned near the 1.34 handle, largely just waiting for the UK's upcoming GDP and industrial output data.
Which could give the Bank of England its own policy wiggle room.
Precisely. And even typically volatile pairs like the dollar-yen were restrained. They were edging higher from the 155 support area, but there just weren't any fresh macroeconomic drivers to challenge resistance levels. It's like the market hit the pause button while the Fed speaks.
Yeah, a total pause.
Correct. Even the Aussie dollar and the Kiwi, they were stagnant, confined to these really tight ranges. This lack of movement, or, despite record high indices, it really underscores that fundamental risk-taking is restrained. Everyone is waiting for the next data point, or more likely, the next political headline.
Okay, let's talk about those political headlines because they represent the, let's call it, global reality that is crashing into this policy fantasy. The most immediate shock seems to be coming from the energy complex, specifically Venezuela.
Yes, crude oil tried to stabilize, but the noise around sanctions enforcement is it's overwhelming.
What's happening there?
Well, what's fascinating here is the escalation from passive sanctions to active physical enforcement. We are seeing reports that the U.S. is actively preparing to seize more oil tankers suspected of carrying sanctioned crude for the Maduro regime.
So this goes beyond just paperwork. This is physical disruption.
It is. This even includes shipments allegedly linked to Iran, so it shows a really broad sweep of enforcement. The reports indicate these moves have already halted at least 3 deliveries.
That's tangible supply.
Yeah.
Hundreds of thousands of barrels being taken off the market immediately.
Immediately. And you asked why the focus on physical assets now rather than just financial sanctions. It's because financial sanctions are often circumvented, through complex trading structures, shell companies, or Russia's shadow fleet.
They're just getting around it.
They are. Targeting the vessel itself, the actual physical asset, is the most direct way to inflict pain and disrupt supply. When you halt a delivery, you immediately reduce the available supply to global markets. That translates instantly into a geopolitical risk premium baked into the price of crude.
So the oil price is reacting to political supply manipulation, not actual demand.
That's it, exactly. And the escalation isn't confined to the sea. President Trump mentioned the U.S. is prepared to start on land soon in Venezuela. That suggests, the possibility of military or perhaps severe humanitarian operations, which signals a major, major risk escalation that oil markets just cannot ignore. And on top of that, new sanctions were also imposed on members of Maduro's inner circle. This dynamic means oil markets are now highly sensitive to direct political maneuvering and rhetoric. They're looking beyond the OPEC reports and straight to the White House and the State Department for guidance on future supply.
And moving from the Caribbean, we're seeing equally intense supply threats related to the Russia-Ukraine conflict and the Black and Caspian Seas. The conflict is increasingly being fought through energy infrastructure targets.
Indeed. We've seen significant reports of Ukrainian drone strikes disabling a key Caspian Sea oil platform and damaging a vessel that was part of Moscow's shadow fleet.
For listeners who might not be familiar, the shadow fleet refers to older, often poorly maintained vessels that operate outside of traditional Western insurance and tracking to transport Russian oil while evading sanctions, right?
That's the one. So, by targeting vessels in that shadow fleet, Ukraine is directly attacking Russia's ability to export its oil and get around the price cap mechanisms. These attacks highlight how the conflict is being fought through the very supply lines that feed global energy markets. It adds another layer of geopolitical risk premium to crude prices.
So the instability isn't just about output, it's about the security of transportation itself.
Precisely.
Meanwhile, the diplomatic rhetoric around the conflict is still incredibly high. Although President Trump did express some optimism that both sides might be close to a deal and that Washington is prepared to attend a key Saturday meeting.
And this is where that market dissonance appears again. Can diplomatic progress truly temper the structural supply risk that's created by these direct attacks? I'm not so sure because the rhetoric from Moscow is still incredibly belligerent.
Right.
Russia's Lavrov made it clear that any deployment of European peacekeepers to Ukraine would be considered a target. That tension keeps volatility baked into the energy and commodity curves, regardless of a single meeting's outcome.
And just to underscore the high-stakes political environment that our equity markets are somehow ignoring, Trump also added that he has spoken with both China and Russia about nuclear weapons.
Which signals a focus on high-level global security dynamics that transcends the immediate Ukraine conflict. It connects right back to that core tension we started with. Markets are hitting new record highs, essentially celebrating policy easing, while major global powers are simultaneously discussing nuclear weapons and seizing physical oil tankers. This cognitive dissonance makes true stability nearly impossible.
Let's pivot now to the third major disruptive force, trade fragmentation. The idea of smooth, globalized trade seems to be actively breaking down.
It is breaking down, and rapidly. We're moving toward a much more regional and bilateral trade framework, which inherently creates friction and volatility. The latest flashpoint is the friction between Mexico and China,
which has massive implications for North American supply chains.
Huge. Mexico has just approved tariffs of up to 50% on a range of Chinese goods. That is an enormous punitive tariff.
Which specific goods are being targeted? And how does this affect U.S. companies that rely on Mexico for, nearshoring?
The tariffs primarily target industrial inputs and consumer goods. So think steel, aluminum, textiles, some specific footwear. These are often high-volume, low-margin products. For U.S. companies, this creates immediate sourcing headaches.
Because they move to Mexico to avoid this kind of thing.
Exactly. Many businesses moved manufacturing to Mexico precisely to benefit from USMCA agreements and lower tariff barriers compared to shipping from Asia. Now, if Mexico imposes a 50% tariff on the Chinese inputs they need, the steel for their machinery, the fabric for their apparel, it immediately jacks up their production costs. It threatens their whole competitive advantage in the North American market.
So attempts at nearshoring are running straight into local protectionism. Beijing has already signaled they're watching this closely.
Very closely. And the complexity just deepens when we look at India. Prime Minister Modi held direct discussions with President Trump because New Delhi is urgently seeking relief from 50% U.S. tariffs imposed on key Indian exports.
And that 50% tariff on India is directly tied to a geopolitical choice: India's continuing purchases of Russian oil. So a decision made for energy security immediately translates into a crippling trade penalty on completely unrelated goods.
This perfectly demonstrates the structural shift. Trade policy is no longer determined by economic competitiveness. It is now explicitly a tool of foreign policy, where geopolitical decisions immediately translate into tariffs. It makes the entire trade landscape unpredictable.
It makes forecasting incredibly difficult. We did see one small positive note, though. Indonesia said its tariff talks with the U.S. are back on track.
Right, aiming to finalize an agreement by year-end. That bilateral movement suggests that while fragmentation is the dominant trend, key bilateral relationships can still proceed. But we have to acknowledge that the pervasive force right now is protectionism.
So we've covered the Fed fuel, the geopolitical shock, and the trade fragmentation. How is all of this translating into commodities beyond crude oil? Let's talk gold and copper.
Well, gold had a surge to a one-month high recently, and while it's taking a bit of a breather today, it remains firmly supported. The softer dollar helps, of course, but the persistent geopolitical uncertainty, everything we discussed about Venezuela and the drone strikes, is the true anchor keeping the price firm. Geopolitical risk requires a safe haven, and gold is fulfilling that traditional role.
And copper, often seen as a signal for Chinese growth. What is it telling us?
Copper had initially pulled back, signaling some caution, but Shanghai trading has helped lift prices again. This is directly tied to fresh stimulus signals from Beijing. They are indicating flexibility on their reserve requirement ratio, meaning they're willing to inject liquidity and are considering targeted rate cuts.
And that stimulus is focused on what sector?
Primarily on supporting the highly indebted property sector. A more proactive fiscal stance targeted at supporting construction means immediate demand for industrial metals like copper. So copper prices are reacting instantly to the probability of new construction. It's a direct barometer of Beijing's commitment to growth.
Meanwhile, back in the risk market, the S&P 500 and the Dow are celebrating these record highs, fueled by that lingering Fed optimism. But as we touched on, the Nasdaq lagged.
And that lagging Nasdaq tells us that sentiment remains sensitive. Technology stocks, especially those tied to the high-flying AI sector, are incredibly vulnerable to shifts in risk-free rates and general confidence. While the overall risk tone is, let's say, cautiously constructive, European equity futures, our positive markets are now operating headline by headline.
So any bad news could wipe out gains instantly.
Instantly. Any negative news from the Fed speakers or a new serious escalation in Venezuela could wipe out those gains because the fundamental valuation is built on the expectation of cheap money, not durable growth.
So for the listener tracking these contradictory signals, we are truly trapped between this policy-driven optimism and global geopolitical reality. What's the strategic takeaway here?
The strategic takeaway is that you cannot rely on the old macro playbook. The market is pricing in a highly supportive central bank environment, this fantasy of infinite cheap money. But the reality is that geopolitical maneuvers, sanctions, and trade friction are generating high real-world volatility and supply risk, particularly in energy and manufacturing. It forces investors to prioritize political risk management over traditional economic forecasting.
It makes everything from choosing an equity sector to predicting the next move in crude oil incredibly complicated, because the political headline can easily overpower months of economic data.
Indeed. We're seeing a structural shift where political risk premia are replacing traditional economic risk premia. You have to track Caracas, Kiev, and the trade decisions of Mexico City just as closely as you track the Federal Reserve minutes now.
So the market is structurally changing its inputs. It forces a different kind of analysis. What's the final thought for people to mull over?
I think you have to ask yourself this. How long can the market truly maintain record highs purely on the expectation of policy easing when the foundation of global energy supply and trade relationships is actively being dismantled? Something has to give.
A powerful note to end on.
The key takeaway remains the tension between highly supportive central bank expectations and the real-world volatility generated by geopolitical maneuvers, sanctions, and trade friction.
That's it for today. Appreciate you tuning in. Join us again on the Financial Source podcast as we continue to track the forces shaping the global economy.